SoFi just dropped its second quarter numbers, and the stock is getting hammered again. Shares are down more than 8% today alone. And if you're sitting on this name, like I am, it stings. Full disclosure, I am holding the bag here. I own just over 1,000 shares with an average cost around $21.50. So this position is underwater by nearly 29%, including today's hit. That is real money on the line, not some detached analysis. Still, the company actually beat on both revenue and earnings and raised its full-year sales outlook. So what gives? Why does a solid report get punished like this? Let's dig into the actual numbers, the specific reasons for the sell-off, and what it means from here. Because the story on SoFi is getting more interesting, not less. Here's what SoFi actually delivered for the second quarter ended June 30th. Adjusted net revenue came in at $1.2 billion, up 40% from a year ago, and well ahead of the $1.11 to $1.13 billion Wall Street was looking for. Adjusted earnings per share hit 12 cents, beating the 11-cent consensus. Adjusted EBITDA reached a record $358 million, up 44%, with a 30% margin. On a GAAP basis, net income was $157 million, also 12 cents per share. The growth metrics were even stronger. SoFi added 1.1 million new members, bringing the total to a record 15.8 million, up 35% year over year. Products jumped 42% to 24.4 million. For the first time, the company added more than twice as many products as new members in a single quarter, a clear sign of deepening engagement. Loan originations hit an all-time high of $14.8 billion, up 69%. Personal loans were $10.7 billion. Student loans surged 170% to a record $2.7 billion, and home loans grew 74% to $1.4 billion. Net interest income climbed 52% to $788 million. Deposits rose $5.3 billion sequentially to $45.5 billion. Net interest margin held steady near 6%. Fee-based revenue also grew nicely and now makes up about 39% of adjusted revenue. Management raised full-year adjusted net revenue guidance to $4.75 to $4.85 billion, implying 32 to 35% growth. Those are the headline wins. So why did the stock fall hard despite the beats? The market focused on what did not improve. Management left full-year adjusted EBITDA guidance unchanged at roughly $1.6 billion, adjusted net income around $825 million, and adjusted EPS at about 60 cents. Raising the revenue outlook while holding profit targets flat signals that margins are under pressure. Investors immediately started calculating the heavy lifting required in the second half. To hit the full-year EBITDA number, SoFi needs a meaningful jump in margins from the roughly 30% level in the first half. There was also clear weakness in the technology platform segment. Revenue there fell 23% year over year to $84.5 million, largely because of the earlier loss of a large customer. Contribution profit in that segment dropped sharply. Meanwhile, sales and marketing spend rose about 48%, and the financial services contribution margin compressed. Lending is carrying a bigger share of the growth right now, and the market has historically preferred higher quality fee and platform revenue over pure loan volume. Higher expenses and the need for aggressive second-half margin expansion created a classic sell the news reaction. The stock had already been under pressure for months, and this gave sellers the excuse they were waiting for. Analyst reaction has been mixed, but mostly cautious. The consensus rating sits at hold, with an average price target in the low 20s. William Blair's Andrew Jeffrey maintained an outperform rating and remains constructive on the long-term story. Truist kept its hold rating and actually raised its price target slightly to $18 ahead of the report. Goldman and others have been adjusting targets higher in recent weeks, but still sit at neutral or hold. No major wave of upgrades or downgrades hit right after the print, which tells you the market had already tempered expectations. Sentiment remains skeptical on near-term multiple expansion until margin progress becomes clearer. Looking ahead, the next major catalyst is the third quarter report, expected in late October. Between now and then, watch loan growth trends, deposit costs, credit quality, and any signs that the technology platform is stabilizing. The Fed's rate path still matters for net interest margin. The bull case rests on continued member and product acceleration, the shift toward higher fee income over time, and the deposit-funded lending model that is already generating strong cash revenue. The bear case is that margin expansion stays elusive and the multiple stays compressed. Personally, I am holding for the long term. I still believe the everything app thesis and the record engagement metrics support higher value over a multi-year horizon. In the meantime, I am running covered calls against 700 of my shares to generate some income while I wait for the thesis to play out. That is how I am managing the volatility. The numbers this quarter showed real operating strength. The stock just needs the market to start believing the profitability side will catch up. This video is for informational purposes only and not financial advice. I hold a personal position in SoFi, which may bias my perspective.